Hello everyone and welcome back to my channel. This is you host, the OG John. And what I'm about to show you is happening right now as we speak. Breaking news. Silver just printed a violent move that looks like a market heart attack, down nearly 14% intraday after trading as low as $72.21 per ounce, and later quoted around $77.36. This is verified on Reuters from February 5th as of 01:31 p.m. Eastern Time. You won't believe what just happened to silver prices, because it wasn't just selling. There were margin pressures, a risk-off stampede, and signs the physical market may be tighter than the paper market. And wait until you hear what London just signaled about physical silver, because spot was trading above COMEX futures out to July, according to Bullion Vault. That's where the hidden truth lives. Stay with me, because what I'm about to reveal will change how you see this entire market. Quick context: silver isn't just a precious metal, it's also an industrial metal. So when it moves like this, it hits investors, manufacturers, and even jewelry companies all at once. What triggered the crisis right now? Keep it immediate, not historical. Stronger US dollar plus broader market rout triggered forced liquidation, according to Reuters. Reuters explicitly quotes a strategist saying, quote, "Some people are facing margin issues and may be covering metal positions because of losses in equities," according to Reuters. "The stakes are clear. If you're long silver or silver miners, you're in a shakeout. If you're short, you're playing with a blowtorch. Let me break down the crash and bounce behavior. The whiplash. February 5th, Reuters from 01:31 p.m. Eastern. Spot silver down 12.1% at $77.36 per ounce after trading as low as $72.21 earlier in the session, according to Reuters. February 6th, Reuters market wrap. Spot silver rose 8.6% to $77.36, rebound day, alongside a broader risk asset bounce, according to Reuters. This is happening right now as we speak. Silver is acting less like a stable metal and more like a meme stock with a PhD. Think about what that means. In a single session, silver drops from around $86 to $72.21. That's a $13 to $14 crash, 14%. Then the next day it rebounds 8.6%. This isn't normal market behavior. This is violent whipsawing that destroys leveraged positions on both sides. What Reuters says is driving it. Dollar strength plus equity stress plus liquidation behavior were highlighted as key drivers, according to Reuters. The quote, worth understanding, margin issues forcing metal position covering. When people are losing money in stocks, when the dollar is strengthening, when margin calls hit, they sell everything. They don't care about fundamentals. They don't care about supply deficits. They need cash now. So they dump silver, they dump gold, they dump whatever they can to raise cash. But here's the nobody's talking about this part, the physical signal. Bullion Vault reports that London bullion silver was higher than any New York COMEX future as far out as July, which it frames as a sign of tight availability of physical supplies, according to Bullion Vault. Think of it like a grocery store where the shelf price is suddenly higher than the future delivery price. People want it now, not later. This is called backwardation, and it's a massive red flag. In a normal market, future prices are higher than spot prices because you have to pay for storage and financing. But when spot is higher than futures, it means there's a shortage right now. People are willing to pay a premium to get physical metal immediately rather than wait for future delivery. The tightening cost of borrowing silver. Bullion Vault reports 1-month silver lease rates jumped to 6.3% annualized, according to Bullion Vault. If borrowing silver got that expensive, what does that imply about real bars in real vaults? It implies there aren't enough bars available to lend. When lease rates spike from normal levels of 0.3 to 0.5% up to 6.3%, that's more than a 10 times increase. That's a shortage signal. Let me dive deeper into the fresh crisis developments. Still anchored to the last 48 hours with hard numbers. Volatility is not fixed overnight. Reuters reports, quote, "Moves like that don't get fixed overnight, and volatility remains elevated, often leading to further downside," according to Reuters. Translation: after a crash like this, the market doesn't just go back to normal, it stays jumpy. Traders are scared, algorithms are triggered, stop losses are hit. The market remains fragile for days or weeks after a move this violent. JP Morgan's warning plus near-term floor framing. Reuters reports JP Morgan's view. Silver valuations look relatively rich and can see outsized corrections in risk-off, even as the bank sees a near-term floor around $75 to $80 and a recovery toward $90 next year, according to Reuters. This is important. Present this clearly as institution commentary, not a fact about future price. JP Morgan thinks 75 to 80 is the floor. They think it recovers to 90, but that's a forecast. That's not guaranteed. And it's worth noting that JP Morgan has massive positions in this market. They're not a neutral observer. Corporate behavior reacting to the chaos, real economy impact. Reuters reports jeweler Pandora is shifting to platinum-plated products to reduce exposure to silver's swings, according to Reuters. When big-end users redesign products because a material got too wild, this isn't just trading. This is the real economy responding to market dysfunction. Pandora is one of the world's largest jewelry companies. They use massive amounts of silver, and they just announced they're moving away from it because the volatility is too high. They can't run a business when their raw material cost swings 14% in a day. This is a structural shift. This is industrial demand potentially declining because of price instability. Macro backdrop: risk on bounce didn't save silver stability. February 6th. Reuters wrap ties the rebound in metals to a broader bounce in equities/crypto, according to Reuters. But here's where it gets interesting. Even with the bounce, Bullion Vault still describes silver as 37.5%, below its recent all-time high referenced as $121 per ounce, according to Bullion Vault. So yes, it bounced 8.6%, but it's still down 37.5% from the peak. The bounce is a dead cat bounce. It's a relief rally. It's not a confirmation that the worst is over. ETF demand shock signals. Investment demand. Bullion Vault claims the iShares Silver Trust SLV saw a 0.8% contraction yesterday, but still up 4.7% weekly, with 724 tons of added backing reported for that week, according to Bullion Vault. Think about what this means. Price crashing versus ETF flows still large. Paper panic versus physical tightness signals. The ETF is still seeing inflows on a weekly basis, even as the price is crashing. That tells you retail is buying the dip. Retail sees the crash and thinks it's a buying opportunity. But institutional money, the smart money, they're the ones selling. They're the ones causing the crash. Now let me give you the background story. 3 to 6 months context. Warning signs. Fundamentals with verified numbers. Structural deficit narrative. Supply versus demand. The Silver Institute says 2025 demand expected approximately 1.12 billion ounces, down 4% year over year. Industrial demand forecast 665 million ounces, down 2%. Mine supply expected 813 million ounces, flat. 2025 deficit estimated 95 million ounces. Cumulative deficit 2021-2025 approximately 820 million ounces, according to Silver Institute. So the market can be structurally tight and still crash short-term when leverage unwinds. This is the key point people miss. Yes, there's a supply deficit. Yes, industrial demand is strong. Yes, inventories are low. But none of that matters when you get a margin call. When the exchange says add cash or we liquidate your position, you don't get to say, but wait, the fundamentals are bullish. You either add cash or you get liquidated. Period. Why physical tightness rumors keep resurfacing? Use the simplest explanation. Paper contracts can be sold instantly. Physical bars have to be found, moved, financed, then anchor back to the lease rate spike and spot above future signal described by Bullion Vault. When you sell a paper contract, it's just electrons. Click a button and you're out. But when you need to deliver physical silver, you have to go to a vault, verify the bars, arrange transport, pay for insurance, pay for storage. It's slow, it's expensive, and if there aren't enough bars available, the price of physical diverges from the price of paper. Government policy/strategic framing. USGS news release published within the last day highlights the value of U.S. mineral production rose 5.6% to $112 billion in 2025, driven by precious metals price changes, including gold and silver, according to USGS. This isn't a silver-only metric, but it supports the policy attention plus strategic materials theme. The government is paying attention. They're tracking precious metals production. They've designated silver as critical. This adds another layer of complexity to the market. Now let's talk implications and discussion. For everyday investors, verified facts. Price can drop approximately 14% in a day, Reuters example, then rebound sharply, Reuters wrap, according to Reuters. What it means in plain English: if you're using leverage, silver is a chainsaw. Even unleveraged ETFs can gap hard. This is not a market for the faint of heart. This is not a market where you can set it and forget it. If you're going to trade silver with leverage, you need to understand that you can lose everything in a single session. Even if you're right about the long-term direction, if you get margin called on the way down, it doesn't matter. For industry, solar, electronics, jewelry example is concrete and current. Pandora shifting away from silver exposure, according to Reuters. If manufacturers redesign because silver is unstable, demand patterns can change. This is a negative feedback loop. High volatility causes industrial users to seek alternatives. Industrial demand drops. That reduces the structural deficit. That removes one of the bullish pillars. Conspiracies versus verified facts. Verified margin pressure plus liquidation plus dollar strength were explicitly cited as drivers by Reuters. Theory label clearly: Some traders will call this manipulation whenever the tape looks unnatural. But as of what we pulled today, the strongest verified explanation is forced selling plus volatility, not a confirmed investigation. Bring it back to what you can measure. Lease rates from Bullion Vault, spot versus futures curve signal from Bullion Vault, intraday lows, and percent drops from Reuters. These are facts, these are numbers, everything else is interpretation. Global impacts, Reuters links precious metals action to broader risk sentiment and geopolitics, U.S.-Iran talks mentioned in the wrap, according to Reuters. When global tensions ease, safe haven demand drops. When safe haven demand drops, gold and silver sell off. It's that simple. Key takeaways, hard sourced. Silver saw an air pocket move to $72.21 per ounce and traded around $77.36 during the sell-off window Reuters described February 5th, 01:31 p.m. Eastern Time, according to Reuters. Next day, Reuters reported silver up 8.6% to $77.36 in a risk rebound, according to Reuters. Bullion Vault flagged spot above COMEX futures out to July plus 1 month lease rates at 6.3% annualized as tightness signals, according to Bullion Vault. What to watch next? Specific indicators, not fake precision. Dollar strength, because Reuters ties dollar moves to metals pressure, according to Reuters. Lease rates and spot versus futures relationship, Bullion Vault indicators, according to Bullion Vault. Signs of forced liquidation, margin stress language from Reuters, according to Reuters. Possible scenarios, label as scenarios anchored to sourced commentary. Possible bearish continuation if volatility needs time to digest, as Reuters cited analyst warned, according to Reuters. Possible stabilization if JP Morgan's referenced $75 to $80 floor concept holds. Still just a bank view, not a promise, according to Reuters. Do your own due diligence. Understand the risks. This market just showed you it can drop 14% in a session. It showed you that spot can trade above futures. It showed you that lease rates can spike to 6.3%. These are not normal conditions. These are stress signals. Silver crashed from 86 to 72.21, then rebounded to 77.36 in 2 days. London spot is trading above COMEX futures out to July. Lease rates hit 6.3%, and Pandora just announced they're moving away from silver because of volatility. Here's the final cliffhanger, the most shocking part. The market's telling two stories at once: paper panic and physical tightness signals, and those two don't stay split forever. What happens when the paper market finally has to reconcile with the physical market? What happens when the lease rates stay elevated and the spot premium persists? What happens when more industrial users follow Pandora and redesign away from silver? Or what happens if they can't redesign and have to pay whatever the physical market demands? That answer is coming, and when it does, the 14% crash will either look like a buying opportunity or a warning shot. Watch the lease rates. Watch the spot versus futures spread. Watch the forced liquidation signals, because the next move will separate the people who understand market structure from the people who just chase prices. Stay sharp, everybody. OG John, signing off.